Good morning, traders, and happy Friday. I'm Jill Malandrino, global markets reporter at Nasdaq, and today we're going to talk about super hot topic, levered ETFs, as the SEC approved for the first time a 4 times levered ETF being offered through 4 shares. Joining me is Chris Dearborn. He's managing director on the markets intelligence desk over at Nasdaq. And Chris, let's run through this real quick. So,
absolutely, Jill.
4 times levered. One of the funds is designed to deliver 4 times the daily performance of the S&P 500 ETF SPY, which everyone commonly trades in our group, while the other one is designed to deliver 4 times the inverse on the other way. So ticker up and down appropriately, but I'm trying to wrap my head around this.
So 4 times is really kind of a brand new idea. Really, originally, the entire mutual fund and ETF business grew from the 1940 Congress Act, which kind of put everything into a bucket. And then 2015, ex-SEC Chair Mary Jo White tried to put it back into the bucket, saying levered, we really wanted to only go 1.5 times as opposed to 2, 3, 4, even more so. And what happens here when you have a 4-time levered ETF is that the volatility within the ETF of the underlying product could be extremely harsh, one way or another. And investors will think they can use this as a longer-term investment vehicle, where really you should be looking on the short term and trying to capture what is happening in the market at that very moment. So ideally, when you have a highly levered exchange-traded product, whether it's an ETF, an ETP, or what have you, what you're looking at there is to capture the movement at the moment as opposed to an investment vehicle for the longer term.
I mean, they even say it in the prospectuses, but okay, so traders, without even looking at the name of this chart, okay, you've got it, there's a couple symbols that come up, but this is the UVXY, one of the levered ETFs that I know a lot of you out there do trade and are starting to learn to use it intraday. Look at this thing since inception. The VXX actually mirrors it as well. I think it's down, what, 99.5% since inception? Absolutely.
So again, when you're trading an item like this, it's a great investment tool. However, if you're holding it for the longer term, obviously it's $12.1 million after it's split so many times, valued at $13 right now. So obviously that's the wrong way to look at it. The right way to look at it is you have certain spikes within the moment, and that's where you have to trade on the higher volume. Again, this thing is extremely liquid, trading 20+ million shares every day. There are a fair amount of options on this that are even cheaper to trade. So as an investment vehicle in the very short term, it is very liquid and very substantial on a profit and loss basis for folks.
Right. Well, I want to go and talk about the VIX, and we'll move on to the next chart. You hear a lot of traders also asking, is the VIX relevant anymore? So, I hear a lot of traders asking, is this thing broken?
The VIX was one of the best leading indicators for a long time of movements within the market based off of the S&P 500, looking at the put options as well as the calls and when the volatility within it. So ahead of a movement within the S&P, which is the broader based index that is most widely used across the board for investment vehicles and as a benchmark as well for beta, what you're looking at here is with the VIX moving up and down would be an indicator. What has happened since we've had a zero interest environment on rates here, money's been basically free to borrow for a number of years, the VIX has become, I wouldn't say irrelevant, but it's now, instead of an indicator, it's a confirmation of the move, what's happened with the S&P. And if you look at this chart here going back over a decade, you can see some of the moves back and forth, but more recently you can see since 2011, where the markets have been on a tear. You see the S&P 500 continuing moving up and the VIX really coming down, and we're trading at a 10 handle. We've been back and forth between a 10 and a 12 handle for the most part for the last 5 years. You've seen some spikes above 20, a few here on 30 on certain one-off items, but then again, as everyone's noticed, when you have a dip in the S&P or the markets in generally, especially after Brexit, China's yuan devaluation, the U.S. election, what you have there is a buying opportunity for stocks, and the VIX spikes up and spikes right back down. So again, it is showing you what happened in the market. It's not a leading indicator of where it's going to go.
Let's go back and focus on the trading end of this again. So why not just buy options on the indexes? Let's say, for example, you have a large portfolio of tech stocks. Do your calls and puts on the NDX?
It's a great way to play a larger portfolio from a cheaper valuation. Again, but you have to be conscious of the rolling forward of the options. Remember, the VIX uses...
Is that why we get these decays and see that huge downtrend?
Absolutely. Remember, the VIX uses current and forward contracts, and they roll them over continuously. That's why it's kind of always trades a little bit of a premium over the top. But in the S&P, when you look, if you're looking to trade option contracts on it, and they are very liquid, SPY contracts are the most liquid option contracts within the U.S. market, you will be able to capture movement and price point, but you have to pay attention to it as well. Because continuously, especially since 2011, the markets have continually moved up. If you're playing it from the short side, you have to be very quick and nimble to capture that movement. And again, if you get called on the stock, if you're in the money and you decide to exercise your options, what happens on those quad witch Fridays, what happens on those, you have high liquidity events where people actually cash out on that. So it's a good way to get put into the stock. If you want to get a longer term investment, it's a good way to trade it on momentum. And it's also a good way to track the market as a hedge to your other positions going forward.
Right.
The options are a great way to trade this.
Okay, well, thank you very much, Chris, as always, for joining me. And thank you, Twitter, for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.